Michael Burry is one of the most well-known investors and traders in the world, but something he did recently may shock you, selling down some of his biggest tech stocks and going all in on gold. With central banks doing something very, very similar, what is it that they know that we don't? In today's video, we'll take a look at that for traders and investors, along with the flows for the GameStop and AMC saga. $5 billion in trades in just a few days, and meme stocks and possibly meme coins set to stay for the next couple of weeks. So what's been happening around the world with the US 500 at all-time highs after the CPI data, Bitcoin breaking out, and of course, GameStop starting to get incredibly volatile? We'll be covering all of that along with the opportunities in the markets right now. Stocks, commodities, and crypto coming your way in today's video. Let's get into it together right now. Well, welcome back everyone to The Daily Show. My name's Tom, and as always, we're going through the latest macro data, leading indicators, and everything you need to know about markets. If it's your first time here, then subscribe and smash that bell icon if you want to better understand the complicated and simplify it in markets, especially when it comes to flows and where are the biggest positions happening right now. So let's get into the biggest discussion that's of course been happening over the last 24 hours outside of the meme stocks, and that is the inflation figures in the US. And everyone's cheering and saying it's great and everything's fantastic, but really I think there are two things to break down. The rent, which remains incredibly sticky. One of the hardest things to get out of an economy is rent increases, and medical care services also going up 0.4%. Now, there were some winners, but realistically, I think when we have a look at it on the surface, we haven't made too much progress over the last 10 months when it comes to CPI and inflation. And part of this is the Fed. The Fed is not restrictive enough in its policy, and that's leading to markets going up and, of course, people being able to borrow more debt. And it's going to compile into a very big problem in the future, which we've been discussing on this show, and we will continue to do so over the next coming years, as I think it's going to be a wild one, especially when we see some of the stats later up in today's show. So CPI month over month for food, that was the big win that everyone's going on about. And of course, we did see specifically food at home go down here to 0.2 negative, which is, I guess, a good thing for all of us, although it's not going to make our steaks or anything else cheaper anytime soon. Maybe they'll stop going up in the shops though. So let's begin with this CTAs, the Commodity Trade Advisors. This is Goldman Sachs' projections of what they believe CTAs are going to be forced to do from a systematic approach over the next coming month. And basically in all cases, it's effectively sideways or down. Now, something very surprising happened with CTAs over the last 24 hours, which we'll bring up later on, but this is one of those charts that you'll want to be paying attention to. Let's also have a look at what people are expecting in terms of hard landing, soft landing, and no landing right now. And you'll notice that the hard landing case has increased a little bit from April, but still very, very low across the board. Most people now think soft landing or even no landing. And in general, when everyone thinks something, it usually does the opposite. So that's something to pay attention to. You can also see here that perception of global fiscal policy is now the most stimulative on record. So basically, whatever the central banks are claiming to be doing, they're not really doing it. They're not being that restrictive, and that's causing further inflation. And of course, most funds are overweight in equities, and sentiment remains quite high here, according to the latest April 2024 figures. So how does this all break down into markets? Well, let's have a look here at percentage of stocks, or sectors in this case, above their averages. Now, the percentage above 50-day average and 200, so the 50 above the 200, that's 100%. Above the 200-day average, 100%, and above the 50-day average, 100%. So basically, breadth is improving as markets are making these new all-time highs. And speaking of all-time highs, we've just gone to 23 all-time highs for 2024 so far. Now, is this a lot? Not really. In fact, you would usually expect us to go to around 40 all-time highs by the end of the year if we follow a normalized bull market kind of run. So is this pretty important? Well, as it turns out, all-time highs are a very important factor when it comes to investing and trading. In fact, according to JP Morgan stats, which I shared over on X, you can go check it out there, follow us, links in the description down below, you would see that the average cumulative S&P 500 total return, if you invested at the all-time high since 1988, has actually been pretty good. In fact, it's actually beaten investing on any other day. Now, that doesn't mean that if you don't understand where pullbacks are and timing the market a little bit better, that you wouldn't have done better than this. But it is interesting to see that when markets make new all-time highs, they do continue generally to do it over time. Although CTAs might have something to say about that, as we'll see very, very soon. So let's take a look at the elephant in the room. And the biggest one that we've been discussing, and we should never forget, is everything to do with the yield curve. Now, a lot of people, especially the more people that say this thing's broken, the better it is. Yield curve inversion, of course, started around 563 days ago now in October 2022. And generally it means a recession is on the way. But you don't usually go into a recession until the market actually uninverts. Now, my kind of thought process here is that we're probably going for one of the kahuna kind of ones, which generally means that I think we're kind of going for like 800 plus days of inversion due to the Federal Reserve and other central banks around the world being too scared to do anything about fiscal policy. And basically, we're going to lead into one of these more kind of nasty sell-offs when they did eventually happen. Global financial, or of course, tech boom, or even, let's hope not, a 1920s or 1966 kind of repeat. So what do you think in the comments down below? Do you think we're going to hit 800? Do you think it's going to be sooner? Let me know what you're kind of thinking at this point. Let's also consider a performance during election years. Now, as you'd be aware, we were following a similar path to 2012. Now, 2012 had a beautiful start, had a pullback, which we thought had kind of like this return. Now we're at actually a new all-time high. I'll update this chart soon. And then what happened during the other one was we actually pulled back and then had a great run all the way kind of to September of this year. Now, I do think this is going to be a hotly contested election. So obviously that means uncertainty. And when you get uncertainty in markets, markets freak out. So there's a good chance there'll be further volatility later on this year. But we might be leading into a kind of more bullish run now if we can't find sells very, very soon. Also, does this all make sense to cyclical bull markets? Well, as I've mentioned before, as of April 2024, we were really not even near the median duration for a bull market. So could the good times keep rolling for a while? I would say yes, they can. And actually what's going to be best here is deciding on the sectors that you want to be in and picking the correct ones. Now, we saw Michael Burry obviously going towards gold. And I think he's making an interesting or pretty good pick there, although I think he's a little bit late to it. We've been talking about gold now for well over $400 or $500 an ounce. But the thing here is that gold is being purchased by central banks. And one of the reasons I think is that when you look at the stock market, although it's probably going to keep going up, the forward returns over a longer investment period, let's say 10 years, don't look very good. In fact, they look like we're going to return 0% on the S&P 500. And what that's suggesting is that we're probably going to see some form of recession or nasty pullback sometime this decade. And I'm kind of estimating it could be 26, 27, and maybe Burry will be correct here, although we don't have the signs yet that say, oh yeah, the terribleness is coming just yet. Wayne Whaley as well, coming out with some nice data when it comes to the beginning of April and how it's been running so far. He found that in similar circumstances, the NASDAQ was up 13 to 0. That's 100% of the time when we had a strong start to the month and we had similar circumstances. So things are certainly starting to improve in the markets. Speaking of improvement, after that CPI result, we saw some good leads. We had our home building construction, very, very nice to see home builders out. We had semiconductors, again, great to see them leading if you are a bull, technology doing well. Interesting, XLRE seems to be possibly bottoming at this point. And then, of course, we've got one of our usual candidates, which is utilities. So all of those did really well. I was surprised to see solar doing a flat day. I thought that might do a little bit better. When we go over the last 5 days, you'll notice that now semiconductors are number one. We had home builders number two, gold number three. So there's a weird smattering of sectors, not what you generally expect. And I think what this is starting to show us is that the market is starting to see that there is two markets here. There's the inflation market. There's the fiscal policy of the overall Federal Reserve, which isn't really very restrictive. And it looks like a lot of the market's kind of going towards good cash flow businesses and obviously inflation-based positions as well. And we've been following those now for quite a while. So make sure to subscribe if you're interested in making sure that you're in the right sectors and therefore hopefully being able to beat those market indices, etc., etc. All right, well, let's take a look at the US 500, and it is an all-time high, and it actually smashed through the 5,300 call resistance level. So as we know, we're in what we call a positive gamma situation. As soon as the CPI result came out, yields dropped across the board, which basically means 2, 10, 20, all of those yields. and we saw the market push towards 52.75. Now, I was doing a private stream for our Market Masters Club, links in the description down below. And as I mentioned, the chance of this moving towards 5,300 during the session was very, very high. Not an easy trade to take from a risk rewards perspective unless you're using options, but yeah, it was a pretty good chance. Now we find ourselves though at a very high point, in fact, above the 5,300, coming into OPEX, which is the trillions of dollars of options expiration, with not really any significant pullbacks since we've actually been rallying up. Now, as you'll notice here, I've got a little stop sign, and what that's telling us is that we're starting to get a little exhausted on this run. And in similar stop sign situations, we ended up getting little sells that ended up, being, of course, buys, and I still think that this one will be, but we're starting to get that little bit of extension. When we look at the one-day expected moves, according to the options market, we've got 53.43 on the top, and we've got 52.73 on the bottom, with call resistance remaining around 5,300. And I think when you break down the structure and you start looking at the smaller timeframes, you'll notice that the market really hasn't been giving exceptionally good pullbacks. The one that we thought would be there, which is this one here during the PPI this week, that was a great trade. Didn't quite get down to the perfect level for an excellent entry, but it had that initial reactions, the wrong reaction, went one way, and then of course went the opposite way straight away. Now, what we're looking for here is if pullbacks come back, it's going to be very hard to ascertain when are the bulls or the bears in this case actually in control. Is it underneath this price or is it underneath 51.60? I would say it's still going to need to be underneath 51.60 because we need to move into what's called a negative gamma environment. And that is certainly not what we're in right now. Positive gamma across the board. And you'll notice on this chart, it's just calls everywhere. Not only is it calls everywhere for the Friday expiration, but it's calls everywhere for the Thursday expiration as well, with 5,300 being an important point. And if markets hold above it for too long, they're going to need to be purchased up to something around 53.50. So basically, we could be going to that one-day high if the markets end up holding through, let's say, until lunchtime in the session. Now, if we do manage to hold back down, 5,300 is where the markets would be quite happy with, making sure to close underneath that resistance by the end of the week. And I kind of expect that the markets will most likely want to do that. So maybe we saw that initial rally, things are looking good. Could be an interesting day of trade on Thursday, but I wouldn't be surprised at all to see a sub 5,300 by the end of the week, especially when we start to look at the CTAs, which have all made new lows. So I told you this would be surprising. Look at these commodity trade advisors. Basically, they are momentum funds and they're systematic funds, really. So in this case, they're systematic funds. They're starting to dump their positions. We've seen Goldman come out and say basically in all situations they have to do this. And yeah, we're making a new all-time high, yet we're seeing dumps. Now, this is actually a little bit behind in the data. So it's about 24 hours behind. I expect this to possibly be lower again. And this could be a first warning sign, although we have no price action yet, that maybe there's a little sell coming in here along with that exhaustion figure we had before. So interesting stuff here from the CTAs. Certainly one of the first things. I've also got a large volume trade that came through, which I think will be surprising as well. What about Brent? So we saw oil be a little sneaky. It's holding the zone that we like very much on the charts, and it did this wick and then bounced straight back up. Notice the CTAs actually dumped the position. I'm going to be very interested in the update on this over the next 24 hours. So of course, I'll do that with you guys as soon as we get it. So CTA is showing us a lot of different things, kind of like the secret viewing passage along with what's going on here with options when compared to what you're seeing just on the charts. What about GameStop? Well, of course, everyone's loving this thing. Maybe not so much anymore. It did go up to $80 in pre-market, maybe even higher. Someone was probably watching it in pre-market the other day. Got crushed all the way back down to the 30s, and it's hovering above the 35 range. And you'll notice that we have tons of calls sitting at around 35, 30, and really this is where the main majority of calls are. If we actually look at all expirations, you'll notice that we do have a little bit of 40s as well, and then we're starting to get a little bit more 50s. So for GameStop to really increase, we're going to need to see a lot more calls come in. And I think this is the important thing. What happened was we had that initial entry, caught a lot of people off guard, heaps of people took profits, flows actually went straight down. I'll see if I can update that in the next video. And now we're hovering around right where you would expect to be. So if you take a look at the chart here, it's actually sitting a little bit higher than you would think at $40. I think between 30 and 30 probably and $40 is where GameStop deserves to be right now based on everything we're seeing. And I would expect it to have a little bit of a chill, and then maybe it can accelerate again. Remember, this is a gamble, so you've got to be aware of that position. And you may also need access to something that I think is pretty special that we'll bring up in today's video, because realistically, this market is so wild that almost all of the profit that needed to be made was actually in the post markets. So there was actually more profit in the post markets than the markets themselves. As I mentioned, $80 being hit in the pre. So you're going to need to have something that gives you access to that. Household expectations to home price appreciation is now at 2007 levels. So people are getting pretty bullish still, and I guess sentiment is still very high across the board. Now, are they delusional? Probably. However, I do think that housing is continuing to show signs of strength, even in this so-called restrictive environment. And I think that this is speculation, which will probably continue for a period of time right now. Both soft and hard landing data is now also starting to fall. Now, I thought this was an interesting one because in general, when we see these kind of hard landing data start to decline, what we're looking at is we're looking at a period of time where we could be into the end of a cycle. Now, if you remember back, I've talked a lot about 2017 to 19. This is where we saw the rise of utilities, the rise of defensives, the weakening of the American consumer, which we track by using XLY, XLP. As it turns out, very similar things are happening right now. So there's a good chance that we'll continue to see the good times keep rolling, but I think the underbelly of the market will start to show signs of cracking very, very soon. When we also look at CPI, you can see here that it's still, I would say, relatively hot. Feb CPI, March CPI, April CPI, yes, it might be down ticking, but based on PPI, we could still be looking up. And basically the Fed funds cuts, yes, they're declining a little bit, but yeah, I think we're going to kind of sit around this zone. So that's good for treasuries if they keep going down. But what do you think? Do you think we're going to get a lot of rate cuts now, or are we just going to kind of float up and down all around as the Federal Reserve goes from dovish to hawkish to dovish to hawkish the whole time? This is a good watch, a little chart here from Goldman Sachs. It just shows you that fear totally got dropped in the market. Basically, we had a little bit of fear come through, and then it went all the way back down. So what's that telling us? Well, it's saying that realistically, no one's very scared of the economy right now. No one's very scared of the potential of a crash. And a lot of the time people say, well, that's the time to buy puts. I think that we need to see some internal cracking, more than just even the bankruptcies that we're starting to see come through. And when that starts to happen, yeah, if puts are still cheap, could be a good time. Timing will be everything on that. For earnings this week, we've still got some big ones coming through: John Deere, Walmart, etc. Baidu, JD, worth watching in the Chinese markets. And you can see here that those are probably the ones that are expected to be the most volatile. If you are trading this one here, then of course Under Armour is expected to be plus minus 11%. JD, Baidu, Take-Two, all expected to be in the vicinity of 7 to even 9% moves. So the options market's saying there's a fair bit of volatility coming forward. Now, I did mention that there was a unusual trade, and there's one here on the ProShares Ultra Pro Short Russell 2K, and you'll notice that there's some big trade coming through here. Now, that's most likely a short position coming into this market, and some of the biggest we've seen ever go through this particular pair over the last 2 years. Now, is this a good time to short? Well, you'll need that really brought through with price action actually breaking to the upside here, which would be the downside on the Russell. But it is a little bit of an inkling that the CTAs and somebody has gone short. I would say, follow the trend, and the trend is generally up at this point. But it's interesting to see them go into it straight after the end of the day on the CPI. So before we jump into the charts and we take a look at all of the key levels you need to be watching, I want to thank the sponsor of today's video, which is Tiger Brokers. Now, not only if you sign up with Tiger Brokers, and the links are down below, will you get access to some additional little goodies thanks to being a member of the FX Evolution community, but also they've just launched something massive, and that is trading US stocks 24 hours a day, 5 days a week. Now, I never thought this would be happening anytime soon, but it is. And this brings a whole new learning curve and also whole new opportunities for traders and investors out there. In particular, I think the last couple of days have really detailed why you may need access to something like this. Because, of course, GameStop and AMC in particular, most of the gains were made by being able to sell pre and of course, possibly trade post. Well, guess what? You can do so now with Tiger Brokers. Let's take a look at how you access this and how easy it is. So it's really easy to access the 24 hours with Tiger Brokers. Go to quotes, click on US, click on 24 hours, and then you'll see all of the positions and stocks that you can trade. Over 500 instruments available. Then you select the one that you want, and you'll notice it has a 24-hour reading on it. And from there, you can go to an overview, including the overnight session. Notice it's down 11.68%, so a totally different position than you might be used to getting availability on. Also, Tiger Brokers has all of the short interest information, valuation analysis, and of course, a whole bunch of analysis, price targeting, and other things, which can be used in other stocks. I'm not sure if it's going to be able to give you any price target analysis though for GameStop, because of course, as we know, it's a bit of a meme. Financial analysis as well, balance sheet analysis, and even a little handy thing that we'll bring up in the future, including an AI assistant that can easily go through and read certain stock analysis for you. So if you're interested in finding out a little bit more about what Tiger Brokers could offer you as a trader and investor, then you can check them out in the links in the description below. And remember, if you're from Australia, there's some extra bonuses there for members. Thanks so much, guys. Check them out now. So let's take a look at the charts now, and we'll start with the VIX. And of course, the VIX is all the way back down into the 12s. So some people will say, well, this is time to go short on the markets. I would say the VIX can stay down here for quite some time. But really, let's also put in a mark here for a watch reaction at 1184, because that would be getting quite low in terms of the bull market would be going in and fear would be pretty much dropping across the board. US yields, all of them have dropped, including the 2-year, sitting at 4.7. Most importantly, we saw the 10-year also dropping off at a faster rate, which means that overall, if we look at the US 2Y versus the US 10Y, we are still heavily inverted. So as long as we remain heavily inverted, really, I would say that markets are still going to remember that in the back of your mind, this is probably one of the most important charts to be checking out over the next coming years. High yield junk bonds increased, basically saying that, yeah, okay, in general, the bonds market is not freaking out too much. And home builders also started to increase with almost a new all-time high. As long as they're still going up, again, the market, in my opinion, is expanding. Meanwhile, we also have copper doing very, very well, and copper showing signs of strength. And as we know, Dr. Copper shows the economy at large, which basically tells us that the Federal Reserve, the central banks around the world, are not doing a very good job at being restrictive, and government spending in particular is leading into kind of an infrastructure boom, which is happening, and copper is, of course, one of the beneficiaries of that. And that's because really all these governments, they're chasing the AI and chasing these new technologies. And of course, they want to be the leaders. Therefore, they can't be too restrictive in their policies. Let's have a look at the US dollar. Now, this was a huge win. Anyone that was short the dollar over the last couple of weeks, in particular, short up in this area here and this area here, in particular, shorting up in this area here and this area here, you would be very happy with what you saw from the US dollar, making its way all the way down to the 104 area, which is an awesome TP zone and particularly good. But could this be the end of the US dollar? Well, I'm going to look a lot at how it reacts around here. Basically, I thought shorts would get to this level. Then we'll see structure. We'll see whether there's a buy, maybe a short-term buy. And if it does take this level out, then I think the US dollar is actually going to start weakening. And as I've said several times, I expect the US dollar to be lower over the next 12 to 18 months compared to its peers, because that's something that usually does happen at around this period in time. Let's now move over to gold. Almost new all-time highs here for gold. We like gold. We obviously saw it go bullish the other day. But in particular, there's been one better than gold, which is silver. So, of course, we saw that the old Michael Burry, he's gone into gold big time. I think that he's probably right in this case. Gold is a very good look at this point because we're probably late cycle investing. We've got central banks around the world vying for the major currency. So who's, of course, going to be the major? And a lot of them are looking to back it versus gold, which is, of course, one of the reads of why we're doing it. Also, gold suffered a lost decade, so it's really time for it to accelerate. And if you're new here to the channel, you might not know that, of course, we've been talking about $3,000 gold an ounce for quite some time, and I kind of still maintain that. However, silver has been the standout because the ratio of silver being at 0.012 is still quite low compared to where it should be, which I believe is around 0.015. So when you put silver versus gold onto your charts, you'll notice that several times before, silver's playing catch up. So there's still more to go for silver, and it looks like it's actually improved on the charts the most, with an exceptionally good inverted head and shoulders if you have a look at it as well. So really nice stuff here from silver, new high, and to be sold are basically going to be sold. It's going to be bought up across the board. Some good levels to look at will be $28 for silver, but this is the inverted head and shoulders if you go onto the smaller time frames. Now we go to the elephant in the room, which is of course oil. Now I've been a big fan of 78 or 79 or whatever it is a barrel. Obviously I've said bull zone for oil for quite some time. And we saw some sneaky CPI shenanigans where the market actually went down, made a new low, rallied straight up, giving us, of course, the bullish hammer. Now, as I mentioned before, for me, it's a scaling position. So this is a good sign, no doubt looks better, but I would like to see oil break through 80 a barrel. Now, if it can do that, nice work by oil. CTA is certainly a little bit worrying, but we haven't got the updated information on that just yet. So we'll see what happened on the CPI day very, very soon. I'll update you in the next video. But I like the wicks, obviously some good stuff happening there. And if it does break through 80 bucks a barrel, then we're probably moving towards 83.50 a barrel. So yeah, that might be a little bit more expensive, but I don't think inflation's gone just yet. And obviously that price action was starting to look a little bit more to in the kind of vicinity of the bulls. Now let's move over to some stocks before we go to indices. We'll start off here with Tesla. And there's no doubt that when you take a look at Tesla, you would say, well, why is it going so negative all the time? We got a nice breakout above 176, closed, pulled back. I'd actually say this is exactly what you would expect Tesla to be doing around this point. It's trying to structure in a low here. And if it's going to find a buyer, I'd be looking at this gap close. So basically, at the moment, we've kind of got like a market that's been weakening. It's strengthened, it pulls back, and ideally it strengthens off that. Now, Tesla is speculative. Obviously, it's got lots of headwind and problems and all sorts of things. But I'm looking at that 172 zone to find a buyer for Tesla. So hopefully there's a buyer there. Otherwise, if we fail at that zone, we're probably going down to 162 for the stock. NVIDIA, this was a good one. Now, someone in our Market Masters Club, they brought this up and they said, Tom, do you think it's going to rally after the CPI? And I said, yeah, actually, it looks pretty good. Options also supported that to the 950 or even 1,000 this week. So there's some decent support for further action in NVIDIA. This was a coil. So basically the market sat there and then it got that momentum, opened up, and yeah, it was actually a very nice trade. So a nice little 3% there. You wouldn't have got the 0.5 because obviously it opened up, but nice little 3% there. Strong move, straight into res. Maybe it even goes to 1,000. You know, NVIDIA, obviously it's been sitting for a while, and it's starting to make some moves ahead of the earnings, but earnings will be the decider. Even slow and boring, though, is still been doing very, very nicely. I just want to show you utilities, a sector that people were discussing. We were talking about it. This thing is absolutely flying. So utilities continuing to increase. And I saw recently as well, and maybe I'll put it in the next video, that there is just a huge expectation of the amount of power draw from cloud and AI over the next 5 years. So utilities might continue to do well for some time in late cycle investing. What about the Chinese stocks? Thumbs up from the price action here as well. Not quite a close above that rejection of the daily, but yeah, HSI doing very nicely, getting towards our 20,000 target, and it's just still basically going up at this point. Aussie 200 also going up, nice 78, 75, moving quite well at this stage is the Aussie 200. So that's a good thing, probably pointing towards a new all-time high. And I kind of feel like the Aussie market will be at like 9K over the next year and a half. That might be a pretty wild call, but if we still see the expansion in financials, commodities, and of course, gold and metals and all these other things, then due to, again, the central bank's not doing enough, then we're probably looking at UK FTSE and the Aussie 200 doing better. US 2K, nice move. We did see a large sell, obviously, come in on this right at these highs. So that's something to be thoughtful of. But really, I don't think you can be kind of worried about that until you break back below these levels down here. So I think from the perspective of the US 2K, it's kind of, floating up at a very nice rate. RSP's also been improving, which we'll look at in a moment. So yeah, it's pretty strong. New all-time high here for the NASDAQ as well. Big tech stocks doing very, very nicely. Again, got a red stop up here showing us that we're probably moving a little bit too quickly. It doesn't mean it instantly sells, but you can see that it can be temporary tops. So CTAs will be worth watching. For now, though, trend is up. I wouldn't be terrified. And all we're really looking at is probably something like this. if it does go bad, pulling back down to where it was a few days ago, and then mostly on the improve. Of course, we'll be updating you though as we see these things come through. RSP, equal weight, doing nicely. No new high though. So again, not fully broad market with the new all-time highs, but we'll be looking for the equal weight to do that. And now let's move over to, of course, the elephant in the room, which is crypto. So we broke the 63.5 and that brought us straight to that 67, which is exactly what we thought it would do. So I knew that, well, I had a very good suspicion that once we broke this and we were entering into that after the CPI number came out, that we would most likely go towards this 67. Now, this is the last lower high. So if you look, you've got kind of like a high, a low, a lower high, a lower low. This is on the daily time frame. So you've got a downward trend. Now, if you break this, then you're out of consolidation realistically, and you're starting to say, okay, we're back in the upward trend. So Bitcoin really just has a little bit more work to do. And at this stage, pullbacks again to be met, you would think, by bull demand. So 67, a very key level for crypto traders. And what I found most interesting is when you look at some of the alts like Ethereum, they're still struggling. So Bitcoin leads, Ethereum comes second, and then as we know, memes and all sorts of other things come third, fourth, fifth, sixth, and seventh. So this is a nice little beginning. And I said, watch reaction here, because I think that, if we break through maybe like 30-60, then we might be starting to see some catch up on Ethereum. So it's actually probably should be at this point, considering where Bitcoin's at, we really should be probably back at about 3,600. So some interesting stuff there on the charts. News for the week ahead, not too many things. Unemployment numbers on Thursday, meh. FOMC member Waller speaks. Okay, we'll see what he has to say. I doubt anything in particular. But of course, price action will be key, and this month's OPEX is also key. Remember to subscribe, smash that bell icon, check us out on some of the socials, and of course, check out the sponsor of today's video. No matter where you are in the world, there may be a special offer for you. So there's quite a few from Tiger Brokers down below. And remember, for the Australian audience, you get $30 of Tesla and an additional $30 of NVIDIA when you fund with 2K within 7 days of the first deposit. And they have a lot of options. We'll be exploring some of those together in the future. Thanks so much, everyone. Bye for now.